Good afternoon, everyone. My name is Andrew Schneck. I'm the Digital Media Manager for Ameriserve Financial. I'd like to welcome you to this final part of our Ameriserve Presents Banking Basics series. If you didn't have the chance to join us in the earlier parts of this month for parts 1 through 3, you'll definitely get a flavor for what Kerri covered in those today. And of course, you can view those sessions on our YouTube channel as well as on our website at ameriserve.com/presents if you're interested. Speaking of our featured presenter, we are once again welcoming our Senior Vice President of Retail Banking, Kerri Mueller, today. The session today is going to be a bit of a recap of our previous 3 sessions with a focus on how those topics blend together for a more complete financial picture. And just quickly, I'd also like to mention, as always, that attendees have been muted upon entering the session in order to avoid any kind of audio overlap. We are recording this session, so please keep that in mind. And if you have questions, we invite you to share those with us in the chat. You should be able to find the chat window in the lower right-hand side of your screen, and I'll be monitoring that feed throughout Kerri's presentation, and we'll do a Q&A at the end. I promise to get to your questions at that time. So, all right, time to get started. Let me get out of the way and turn things over to Kerri.
Thank you, Drew. And thank you for joining us for our last webinar today, highlighting the last 3 PowerPoints covering the basics of banking, how to budget successfully, and credit and debt. We'll start off today by summarizing the products and services that most retail banks offer consumers. We spoke about deposit accounts, which include checking accounts. A transactional account is a type of demand deposit account mostly referred to as a checking account. It is a bank account that retail banks make available to their customers for the purpose of securely and quickly providing access to funds on demand. They are the accounts that customers will typically use to pay everyday expenses. For example, your rent, utilities, groceries, and other store purchases. These are the accounts that traditionally use checks as a form of payment. However, with the move to online banking, they also use debit cards, which we will cover in a few moments as well. These accounts are very convenient also for customers that really don't have anywhere to store their money other than underneath their mattress. And they normally don't earn interest. However, there are some that will offer a nominal interest rate or other rewards on these accounts. Therefore, it's always best to shop around for the best product that meets your needs. The next type of deposit product that we covered was the savings account. Savings accounts are once again demand deposit accounts used by customers who may not need an immediate need for their funds, but may want to ensure they have quick accessibility in case their financial situation changes. These accounts offer a range of interest rates. However, the rates again are typically lower than what a customer could get if they would deposit their funds into a somewhat longer fixed-term deposit product. By opening a savings account, you take the thinking and effort out of savings and reduce your temptation to spend that money elsewhere. The amount you choose to save does not have to be large, because most savings accounts can automatically move money from your checking into your savings each month, so you do not even have to think about doing it yourself. And the last deposit product that we covered was CD or term deposits. A CD or certificate of deposit is a type of savings account with a fixed interest rate that is usually higher than a regular savings account. It's a fixed term length with a fixed date of withdrawal, also known as the maturity date. You lock up funds in a CD for a term that generally ranges from 3 months and usually can go out to 10 years. Like a savings account, they provide a way to put money away for a specific savings goal, such as a down payment on a house, a new vehicle, or a big trip, or just to park funds that you simply don't need for day-to-day expenses, all while earning a certain return on your balance. Once you purchase a CD, you cannot access the funds until the maturity date, which is when the entire term ends. Once matured then, the owner of the CD can withdraw the funds plus any interest accrued over the time of the CD. If you need to withdraw your funds early, you will likely have to pay an early withdrawal penalty. Investing in CDs can make sense if you want to avoid the volatility of the stock market and earn a rate that may be typically better than some other savings accounts. The general rule of thumb is the longer the term, the higher the rate of interest that will be paid. Now moving on to some of the credit products that we covered, such as a debit card. A debit card is a payment card that lets you make secure and easy purchases online and in person by drawing money directly from your checking or your savings account. You are not borrowing from a line of credit like you would with a credit card. The money on your debit card is your own. You can also use a debit card to access your cash at ATMs. Debit cards partner with major credit card brands such as Visa, MasterCard, and Discover to allow you to use your debit card payment anywhere that these branded cards are accepted. The second credit product is obviously a credit card. Now, a credit card can be issued by financial institutions, which lets you borrow funds from a pre-approved limit to pay for your purchases. The limit is decided by the institution issuing the card based on your credit score and history. Generally, the higher the score, the better the credit history, the higher the limit that you may be offered. The application and the approval process on a credit card happens almost simultaneously as it is an automated process. The key difference between a credit card and a debit card is that when you swipe your debit card, remember, the money gets deducted from your bank account, whereas in the case of a credit card, the money is taken from a pre-approved limit. The second type of credit product is a personal loan. A personal loan is an amount of money that you can borrow to use for a variety of purposes. For instance, you may use a personal loan to consolidate debt, pay for home renovations, or plan a dream wedding. Personal loans can be offered by banks or online lenders. A personal loan should help you reach your financial goals, though, rather than contribute to a debt problem, which is why it is recommended that you use only one when it saves you money, improves your income-generating capabilities, or helps increase the value of something that you own. The other and last type of credit product that we discussed were mortgages. One of the biggest investments that you can make is when you choose to buy a home. A mortgage is a loan provided by a mortgage lender or a bank that enables an individual to purchase a home or property. While it's possible to take out loans to cover the entire cost of a home, it's more common to secure a loan for roughly 80% of the home's value, which usually requires the borrower to provide a 20% down payment. There are other programs available as well by banks that require only a 5% down payment if you meet all the requirements. The property itself or the home serves as collateral for the loan. The mortgages are available in a variety of types, including fixed rates and adjustable rates. You just need to check with your local bank or mortgage originator for more details on mortgages. Now, next to insurance products or investment products, and one of the biggest investment products that are offered by banks is, in fact, insurance. One administration service generally available in our bank's trust department or in the administrative department is actually estate and insurance needs. Estate planning is one of the bank services that focuses all about ensuring your wishes are met after your death. It is important to understand that all your estate plans should include a will and powers of attorney. But in many cases, an actual trust has additional benefits beyond what can be accomplished with the wills and powers of attorney. Now, trusts are often funded with a life insurance policy. which actually provides the assets that will be used after the death of the insured for the benefit of their family or often other heirs. Particularly for the parents of minor children, the combination of life insurance and a trust may be the best way to ensure your children have their financial needs met while also making sure the assets are used in ways that you desire. Although nobody wants to think about death, however, life insurance provides a lot of benefits when it comes to setting up your estate plan, and having life insurance and a trust provides a multitude of benefits. The next investment product is retirement planning. This is another administrative service that a bank can offer, and it often refers to financial strategies for saving, investment, and ultimately the distribution of money meant to sustain oneself during retirement. In the simplest sense, retirement planning is the planning that one does to be prepared for life after paid work ends, not just financially, but in all aspects of life. The non-financial aspects include lifestyle choices such as how to spend time in retirement, maybe where to live, or when to completely quit working. Retirement planning is ideally a lifelong process. You can start at any time, but it works best if you factor it into your financial planning at your bank from the beginning. That is the best way to ensure a safe, secure, and fun retirement. The next topic is budgeting. And this is a topic that we spent a lot of time actually on and several slides on. And a good starting point that we're going to cover is how to create a budget. And when you look at how to create a budget, you need to designate between your needs versus your wants. Needs obviously get priority, and every budget should cover those first, because needs are things required for daily life. Food, clothing, housing, and unavoidable costs associated with everyday living. Wants are things that you possibly could do without if you had to. Something that makes life more comfortable or enjoyable. Designer clothing or a sports car could be designated as a want. But distinguishing between needs and wants will help you live within your means. And part of creating a budget is also distinguishing between the next two terms, your variable expenses and your fixed expenses. Variable expenses are the type that will change from month to month, such as your groceries, gas, entertainment, or maybe eating out. Fixed expenses are those mandatory expenses that you pay the same amount for each time. Items included here are things like your mortgage or rent payments, car payments, regular child care, and so on. And finally, it is important to understand the difference between all types of income. Knowing the difference will help you when planning your expenses. Simply put, the money that comes from your household is called income. There are many sources of income that can fund your budget. Gross income is your total income before any taxes or deductions are taken out. Your net income is the money remaining after taxes and deductions have come out, and this is what's actually used for your budget. This is your take-home pay. And finally, discretionary income is the money then that you have left over after all your bills and obligations have been paid. It is actually what you use to achieve your financial goals. Now, to create a budget that works and allows you to live a comfortable and happy life, you need to get a firm handle on what you're currently spending, what you can afford to spend, and what your priorities are. And there's a few steps that we're going to go through and review so that you can remember how to spend smartly. The first one is to gather your financial paperwork. Before you begin, gather up all your financial statements, including your bank statements, your investment statements, maybe a recent utility bill, your pay stub, any credit card bills. And it's also a good idea to maybe have your statements from the last 3 months. because you want to have access to any information about your income and expenses to help making a budget easier. One of the keys to the budget making process is to create a monthly average. And so the more information that you can dig up, the better that you are going to be. Number two is then to calculate your income. How much income can you expect each month? If your income is in the form of a regular paycheck where taxes are automatically deducted, then using the net income or the take-home pay amount is fine. But if you are self-employed or maybe have outside sources of income such as child support or Social Security, you want to include those as well. Record this total income as a total monthly amount. If you have a variable income, meaning, for example, that you have a seasonal job or a freelance job that maybe happens every now and then, it's best to consider using the income from your lowest earning month in the past year as your baseline income if you're going to include that in your budget. Number three, create a list of monthly expenses. Write down the list of all the expenses you expect to have during the month. And this list could include mortgage payments or rent, car payments, insurance, groceries, utilities, entertainment, eating out, childcare. I could go on and on. But make sure that you include all of the expenses that you think that you may have. Use your bank statements, receipts, and credit card statements from the last 3 months to identify all of your spending, just in the event that you might not be able to remember. Now, after all that, your fourth step includes you want to now write down, have your expenses all written down, and you need to determine which are the fixed then and which are the variable. So just like fixed income and variable income, fixed expenses are those mandatory expenses that you pay the same amount for each time. They include your items like your mortgage and your rent payments, and maybe internet service, regular child care. If you pay a standard credit card payment, that's going to be included in your fixed expenses as well. If you plan to save a fixed amount or even pay off a certain amount of debt each month, you may want to include that in your fixed expenses. As we defined earlier, variable expenses are the types that will change from month to month. So if you do not have an emergency fund, include a category, very good idea, include a category for surprise expenses that might pop up over the month that might derail your budget. Start assigning a spending value to each category then, beginning with your fixed expenses. Then estimate how much you will need to spend per month on those variable expenses. If you are not sure how much you spend in each category, again, review your last 2 or 3 months credit card or bank transactions to make a rough estimate. And number 5, total your monthly income and expenses. If your income is higher than your expenses, congratulations, because you're off to a good start. The extra money means you can put funds towards areas of your budget such as retirement savings or paying off debt. If you have more income than expenses, you may also want to consider adopting the 50-30-20 budgeting philosophy that we reviewed. In the 50-30-20 budget, needs are, or essential expenses, as they're known as, should represent half of your budget. Wants should make up another 30%, and savings and debt repayment should make up the final 20% of your budget. Now, if your expenses are more than your income, that means you're overspending and you need to make some changes. So, we need to make adjustments to expenses. If you are in a situation where your expenses are higher than your income, you need to find areas in your variable expenses, meaning those that change every month, where you can cut. Look for places that you can reduce your spending, like eating out less or eliminating a category like canceling your gym membership. If your expenses are far above your income or you have significant debt, reducing your variable expenses might not be enough. You may need to trim your fixed expenses, and increase your income to balance your budget. The main thing is you need to aim to have your income and expenses columns to be equal. This equal balance means all your income is accounted for and budgeted towards a specific expense or savings or even a goal. And as always, you are going to continue to review and tweak. Circumstances change. Our priorities shift. We change jobs, we move, we have children. We need to make an appointment with ourselves every few months to sit down with a budget and make sure it's still working towards our current goals and realities. If you've already got your numbers plugged into a program or a website, it's easy just to play around with your budget to see where you can create extra room or maybe change your priorities. Remember, your budget needs to work for you, not the other way around. Now, having a budget is knowing where your money is going instead of wondering where it went. This sense of control can reduce your stress and help you reach both short and long-term financial goals. So the first thing is to eliminate those budget busters. These small things do add up, whether it is excessive ATM fees, maybe eating out every day, or spending money carelessly. That money can go to other financial goals and savings. Understand your needs and wants. Your home, safety, and food are things that you need. Number two, know your income and expenses. Beware of the lifestyle creep, because as you earn more income, do not spend it all. With every increase in income, you need to budget half of the money to your savings and add the other half to discretionary income. Make sure that you are living within your means. Total income minus total expenses should be a positive number, because if it isn't, you're going to need to adjust how much you need to spend on your wants. And number three is tracking your expenses. Calculate your spending categories. Then use the 50-30-20 rule. The recommendation, again, is 50% of your income should be for needs, 30% for wants, and 20% for savings or debt. You'll use the tools and methods where they're available and understand where your money is going by creating a written or online budget. Figuring out a final budgeting method for you is the first step, and maintaining and tracking your budget takes practice. This practice eventually will form a habit, and if you continue to use the following strategies, it should ultimately help you move forward in creating your budget and hopefully reduce your stress. Now, the last webinar we covered summarized credit card debt, and one of the most important things you can do is to manage this and pay attention to your credit report. And you can do this on a consistent basis. So the Fair Credit Reporting Act, which is the federal law that controls the fairness and accuracy of your credit reporting, requires each of the 3 credit reporting bureaus to supply consumers with a free credit report once per year. On annualcreditreport.com, you are entitled to a free annual credit report from each of the 3 credit reporting agencies. And these agencies include Equifax, Experian, and TransUnion. Now, due to the COVID-19 pandemic, many people are experiencing financial hardship. So to remain in control of your finances, you can get free credit reports every week through April of 2022. Request all 3 reports at once, or you can do them one at a time. Federal law also entitles consumers to receive free credit reports if any company has taken adverse action against them. This may include a denial of credit, insurance, or even employment, as well as reports from collection agencies or judgments. However, consumers must request a report within 60 days from the date of the adverse action letter or when it occurred. In addition, consumers who are on welfare and people who are unemployed plan to look for a job within 60 days, and victims, especially of identity theft, are entitled to a free credit report from each of the reporting agencies as well. So there's plenty of options for you to take to make sure that you continuously check on your credit, keep it in good shape, and make sure that there's nothing on there that shouldn't be, so that when it's time for you then to put your budget in place, your credit report is ready to go as well. Now, there's another way to check your credit score. And the next way that you can do that is by simply on some credit card statements or some other loan statements that you get in the mail. It's as easy as that. Many major credit card companies today, and even some auto loan companies, have begun to provide credit scores for all their customers on a monthly basis. And the score is usually listed on the monthly statement, or it can be found by logging onto your account online. Another way that you could access a credit score is maybe just using a credit score system or a service. Many of these services and websites advertise free credit scores. Some sites may be funded through advertising and not charge a fee. Other sites, though, may require that you sign up for a free credit monitoring service with a monthly subscription fee in order to get your free score. These services are often advertised as free trials, but if you don't cancel within the specified period, you could be on the hook for a monthly fee. So please be sure when you're checking your credit score, before you sign up for one of these services, be sure you know what you're signing up for and how much it really does cost. And the last way is simply buying a score. And you can buy your score directly from credit reporting companies. At myfico.com, you can simply just purchase your score and find out what it is. Other services may also offer scores for purchase. If you decide to purchase a credit score, you're not required to purchase credit protection, identity theft monitoring, or other services that are offered at that time. It's simply just getting your score and keeping on top of it. So the next three slides are going to show a few situations we're going to go over just so that you can see and maybe relate to one of them as to what some of your choices are based on all of the different topics we've covered in our webinars. So the first situation is Molly is an 18-year-old freshman in college, and she's asking for help on what she should be doing as someone new to managing her own finances. This is a pretty common area that most seniors coming out of high school that may not have been taught this in school are dealing with. Most college students get bombarded with credit card offers, and you're dealing with student loan applications, and they're not real familiar with what to do. So some of the most basic options that you can look at is, one, opening a checking account if you already don't have one. This is going to help you learn to manage your finances as well as help to track your finances. Number two is to carefully consider how to start building a credit history. Please, please don't get into the habit of filling out all different types of credit card applications and maxing out credit cards at such a young age, especially in college, because normally you may not have the income to repay. And that can ruin your credit early on, which is definitely going to have a big impact on you as you get older. You want to buy your first car, you want to buy your new home. So pay attention to that. And number three is understand that all loans must be repaid, and payments need to be made on time to avoid damaging your credit score. So once again, as I spoke to about your credit cards, it's the same thing with loans. If you do have a car loan because you do have a car at school, make sure that you pay on time. Because again, at a young age like that, it's the most important time you need to pay attention to your credit history. The second example is Stephen and Jennifer are newlyweds. So they're in the next phase of life. They are looking to purchase their first home, but they also want to start building their savings. So what are some of the things they can do? Well, they can start saving for the down payment of their new home with a savings account. Remember, we spoke of that. They can use a savings account, If they have a little extra money, they can also invest in a long-term CD that might earn them a little bit more interest rate. But these are the deposit products that are going to allow them to put the money away and really not have access to it, so that it's not so easy as it is with a checking account to write a check or go to the ATM to withdraw. This is the money they need to save for their down payment. And as we went over mortgages, most mortgages require a 20% down payment. They can also make sure they've been keeping their credit reports in good standing by making on-time payments and limiting their open lines of credit. Again, it gets back to what I was talking about in keeping your credit up to date and making sure that you're keeping your credit scores up to date by constantly paying your bills on time and also checking your credit by going to one of the different sites or by buying your credit score. Next is consider putting some money aside in a CD to take advantage of a higher interest rate. And that's how I had mentioned that in the first part of this. Either a savings account or CD is a great way to put away that money and not have access to it. And begin thinking about how they can start long-term savings for retirement. Look up your local bank, talk to some investment advisors, go to your trust department of your local bank and talk to them about some of the ways, even if you're working and your employer offers a 401k, it's a great way for you to put money away. And example number 3 is in the next phase. Erin is turning 55 next year and is really starting to think about retiring. So here he is at the end, and he's thinking about retiring within the next 10 years. He has some concerns because he thinks he should have started saving a little bit sooner than he did. Well, again, as I had mentioned, it's never too early or too late to start saving for retirement, but obviously the earlier the better. Consider reviewing his retirement savings plans with a trusted financial services expert. So just as I had mentioned, we have retirement experts at the bank. We also have financial services experts at the bank. They can give you advice on your 401k. They can give you advice on some other options of what you can do to make sure that you have the money that you need to live on after retirement. And start thinking about how to pay down long-term debt to free up the money for savings or monthly expenses after retirement. Obviously, as we all know, after retirement, our income is somewhat lower than what we normally are used to whenever we have a paying job. So we want to make sure that we don't have the same level of debt that we have when we are working. So we want to look at possibly paying down as much as we can. And there's people at banks, whether it be financial services, retirement services, or either people in your own local branch that can help you get on the right track. So in conclusion, the benefits of managing finances intelligently can build wealth for you and your family. So whether it's deciding which products and services are right for you, establishing a budget to meet your needs, or managing your credit and debt so you can live comfortably, you can get there one step at a time. It will take patience and determination. However, you achieving your goals can be the most rewarding accomplishment you'll ever have. So I thank you for joining me during this webinar series, and I'll take any questions at this time.
All right, thank you, Kerri. Just one question so far, and it relates to the financial services experts and so forth. Is there any fee or cost or anything to talking to your preferred banker or financial services person to sort of start getting an idea of how you can go about doing some of this financial planning?
That's a good question, Drew. Normally, no. Normally at the beginning, most financial experts, whether it be at your local bank or other organizations that you go to, there's no fee. They normally have a no obligation fee service where you can go in initially and you can talk to them about what kind of plans you're looking at, maybe seeking some advice at the beginning. Now, if you decide to use them as a long-term advisor and maybe sign up and open up some different products and services with them, then at that point in time, you're probably going to be looking at some fees, from that advisor or from that company itself. But initially, once you go in for a no obligation, first time sit down, there's usually no fee associated with that.
All right. I haven't gotten any other ones, so I think we'll just leave it there. But thank you so much, not only for today's session, but for all of the sessions this month. I think it's been incredibly informative.
Thank you. Thank you.
All right. Well, once again, Kerri Mueller from our retail department, a senior vice president in charge of retail, has been with us all month. And this session, just like the other three, will be up not only on our website link, but also on our YouTube channel we usually have them up there within 24 hours or so. So if you missed the beginning or want to just rehash anything, by all means, check it out over there. And next month, I believe we are going to have a session with our trust department talking about financial and retirement planning. So that should be a nice transition from what we talked about today into talking about retirement savings and so forth with our trust folks next month. So once again, Kerri, thank you very much, and hopefully we'll all have a great afternoon.
Thank you. Bye-bye.